During the week. Now, joining me on the show tonight is special guest Effie Zaros, editor of Money Magazine, and David Buckland, CEO at Montgomery Investment Management. Our caller very shortly. Let me just ask you, David, the market. Where do you see the Aussie market at the moment, sitting around that 5,600 level? Are we cheap or expensive?
Oh, a little on the expensive side, Sam. So what's happened is that there's a large proportion of the market are really struggling to grow their earnings in a very sustainable way, and I think the extremely low interest rates are obviously supportive, but I think there's better opportunities typically offshore in general terms, just because there's so many high quality businesses that have just such solid earnings growth prospects.
Yeah, absolutely. Now, I was going to go to a caller, but I might just bring up your charts if we can, just while you're talking us through it. What are some of your favourite stocks in the Aussie market at the moment? Healthcare has certainly been a popular one, but it looks like it's pretty mature, doesn't it?
The problem with the really high quality businesses that have delivered superb earnings growth over recent years is they are not cheap. To really find high quality businesses, good prospects that are reasonably cheap, we would look at things like Challenger Financial. We would look at, in fact, Henderson's, which is the old demerger from the AMP. They actually are listed in the UK as well as Australia, and they actually reported tonight and reported a superb set of results, and they were up 2% in the UK as they started trading. Realestate.com we like very much. That's traded down in the high 30s recently. We think there's very good upside with that one.
You're not concerned about domain grabbing market share from real estate? Are you looking at their overseas options?
We're not concerned at all. Bendigo Bank we think will do relatively well with the issues surrounding our big four, and we can touch on that later. And then finally SEEK. There was a period of time, particularly during the sort of the Greek and I'll call it the Chinese crisis, where SEEK fell about 20 percentage points. And our argument at Montgomery Investment Management is that a large proportion of that fall is temporary, not structural.
That was off the back of their TAFE implementations, was it not?
Yeah, the education side of their business, which is a very small portion of their total business.
Yeah, absolutely. Yeah, good on you. And you've been branching into the international space as well.
Yes, so we launched two products on July the 1st. One's called Montgomery Global Fund, and we're very pleased with how that's kicked off in recent weeks. And one's called Montica, and they're very similar products. The first one is effectively just buy shares and has a bit of cash, and the second one buys shares, but also, interestingly enough, sells shares in businesses that we see are deteriorating and where we think we're ahead of the pack. So a classic case would be something like Prada, which you probably know well, Effie. But,
I'm on a budget.
But interestingly enough, Prada's got same-store sales that are declining dramatically, as have a lot of other very big, well-known global luxury brands. Their same-store sales are declining, and in fact, it's only through massive store expansion that their revenue line is relatively flat. But what's happening is they've got massive premium sort of ratings, and when same-store sales decline, what happens is your operating earnings really start to get hit quite dramatically, and we're seeing that with Coach and Abercrombie and Fitch and a number of other brands. So the idea is to actually sell businesses which you think are deteriorating, but where you're well ahead of consensus on that call.
You look at any of the market darlings. I mean, Twitter got belted last night. Facebook's had a terrific run, probably up 20% plus in the last month or so. Are you looking at any of those sorts of stocks?
Look, we really want to be able to categorise that sort of deterioration. And so, for example, if you were on shorting iron ore 3 years ago, like Australians could never see iron ore get below $100 a tonne 18 months ago, and suddenly here it is at half that, and everyone woke up one day and went, oh, it all looks very terrible out there.
The government certainly never saw it, did they?
No one saw it, particularly not the iron ore producers. Coal's another classic case. It's more than half, but interestingly enough, China is a massive producer of coal, and in fact, seaborne train of coal dwarfs China's production. China are cranking up their production. Their cost base is lower, so coal could be in the quagmire for a long period of time. So there's these long plays. There's print media that we've known about ever since the Rivers of Gold. gold became the rivers of something else. We've seen, now free-to-air is coming under dramatic pressure from streaming and Netflix and things like that. So there's all these themes that if you get onto them early, you can sort of ride the share prices down and actually make money on the downside as well as buying high quality on the upside.
Yeah, good on you. Very interesting. Now, we've got a caller on the line, Barry from Sydney. G'day, Barry. Welcome to the show. So, thanks for your patience. Go ahead.
Oh, good evening, Sam, and good evening, panel. Sam, my wife and I were having an interesting conversation with our youngest daughter, who's 30 years old, the other day about super. And she was telling us that she realises she's probably got another 30 to 40 years left in working life. And she has approximately $36,000 with Australian super in a balanced fund. And she was telling us that she was considering actually changing that to a high growth fund, plus also paying in an extra $300 to $500 a month into that fund. She earns between $55,000 to $60,000 a year. Not interested in salary sacrificing, but she thinks this is a good plan, and I thought that I'd give you guys a ring just to bounce it off you to see if she may be on the right track in terms of saving for her future retirement.
Yeah, good on you, Barry. I really appreciate the call. It's a really good question and great comments. Well, it's great. David, have you got anything to add on this?
I would just say that I think when you've got a 30-year career left, you should definitely be on the more aggressive side of the spectrum. That's point one. But point two is timing, I think, is actually quite crucial, and that is that at present we've got a scenario globally where interest rates have never been lower, and secondly, US corporate profit margins have never been higher. Australians, actually all investors I should say, have a great inability of trying to buy high and sell low. So what I would actually encourage your daughter to do, Barry, is next time there's a really serious pullback, then say to her, darling, it's now time to get a little bit more aggressive, and stay aggressive. It's all about sequencing. If you buy after a pullback rather than pre a pullback, you really do get a bit of a sort of favourable tailwind.
It's becoming a bit of a fad topic, sequencing, hasn't it? But it's something that a few of my clients do too. When the market's down, when it was down at 5,400, that's a time to sort of switch back into being aggressive. It's typically where the news is the worst. How do you encourage people to get into a market when the front page of the newspaper is saying that the sky's falling?
Well, it's just being contrarian, and we saw in 2007, particularly when Peter Costello, gave a certain amount of sort of encouragement into super, people could not help themselves but go and spend that money very aggressively. And unfortunately, the timing in hindsight was very poor. Then you come to 2009, post the GFC, when things are absolutely at their multi-year low, and you couldn't get anyone to buy anything. And so I'm just saying that most people like to buy high and sell low, and if you can just reverse that and get your headspace in being a little bit contrarian, you can do much better than the average.
Do you have anything to add to insurance?
Oh, just 2 points: that Australians are chronically underinsured, and number two is, I think it's very much, as Effie said earlier, it's up to your personal situation. So, for example, if you're 40 years old, have a mortgage, have a wife and young kids, and your wife isn't working at the moment, and you fall over, metaphorically, I think it's just ridiculous that you wouldn't have insurance.
You've got to have it, don't you?
I think you've got to have it. So, but if you're the 25-year-old kid living at home and you're dependent on mum and dad, not such a big deal.
Now, we've got an email here from Lawrence. Lawrence writes, I have a question about annuities and other structured retirement products. Presumably there is some assessment as to how long I will live. Who makes that assessment and how is it made? Presumably the longer the guesstimate of life expectancy, the less income one would receive on a yearly basis. Is that correct? Yeah, that sounds about right, but they would be working off the life expectancy tables. So there are life expectancy tables that come out on a regular basis. We can tell you that the average Australian female is living to about 83, the average male about 79.5, it's possibly into the 80s now, but they're the life expectancy tables that they work from, and I can tell you there's been a huge take-up of annuities over the past few years. David, one of your stocks you were talking about on your list is Challenger. I think they've got 6 billion plus, 7 billion plus of annuities. They're doing a roaring trade.
They're doing brilliantly, and they've in fact got the market pretty much to themselves at the moment, and the banks have found the space probably too small to really attack Challenger in. So You know, Challenger is one of our preferred stocks, not just because we're talking about superannuation hitting 2 trillion, but forecast to probably head up towards 7 trillion over the next 18 or 20 years, depending on investment returns. But secondly, within that 2 to 7, the annuity component will grow so much more quickly. So we think that Challenger has this sort of wonderful tailwind behind it. And as I say, eventually they'll have a lot more competition. But at present, they've really got the space, you know, largely to themselves.
Would you support people buying into the annuity space at the moment? I mean, we've got record low interest rates.
Yeah, look, what worries me about investing generally at the moment is that one day interest rates will go up. And so if you go and lock in something as an investment, not as a borrower, but as an investor, you know, you will be decades before you get your money back. And that's the issue. So what I like to do when interest rates are at record lows is just have the money earning next to nothing for a rainy day, because eventually rainy days always come. And then you get the money out, you have that liquidity to go and buy those opportunities that have been smashed up because of either rising interest rates or rising unemployment, and then the opportunities arise.
Very good. It's insurance, but let's go to our expert, David. What do you reckon?
Hi Nathan. So QBE is around about $10.50. Our valuation at Montgomery Investment Management is about $11.50. It's a $15 billion market capitalisation stock, and as Sam said during the introduction, a large proportion of the company's assets are primarily based in the United States of America, so declining Australian dollars certainly assisted the business there. QBE's been a funny company. It was very much loved by the investment community for a long period of time. It made a lot of very, very large acquisitions, and then suddenly that roll-up stopped working so well. The share price came back, I think, from north of $30 and came back to sub $10 very, very briefly, and as we now know, it's rallied to about $10.50. You know, I wouldn't obsess about dividends, to be honest with you. There are many, many businesses where people buy them for those stocks because of their dividends. So let's just take Telstra as a simple example, something that probably every self-managed super fund in the country would own. 10 years ago, the Telstra dividend was 28 cents. This year it's 30 cents. So it's gone from 28 to 30 in 10 years, and everyone buys it because of the dividend yield. I compare that to other telecommunications company, which is tiny, called M2 Telecommunications. 10 years ago, its dividend was 1.25 cents. Today, it's over 30 cents. So I would much rather you focus on stocks that have very, very, very good growth profiles, and the dividends will look after themselves, as distinct from stocks that behave a little bit like a bond, where the dividend, as I say, goes from 28 cents 10 years ago to 30 cents today. To me, that's just a bond. It'll go up and down on interest rates. Interest rates go down, stock performs. Interest rates go up, the stock underperforms. I think much better to find really, really good stocks with strong, reliable, sustainable growth.
David, we all love good Aussies, but unfortunately there's a lot of gamblers out there when it comes to stocks. And what I often realise when I watch this particular show on other nights is that a lot of people are gambling with their superannuation money, which concerns me greatly, because they don't understand the companies in which they're investing. They just see them as three-letter codes that go up and down in value, and they're hoping to buy them when they're in the down phase and sell them in the up phase. It's pretty much as simple as that. When you look at a company like QBE, we've had a highly competitive sort of market. We've had a history of bad announcements, poor announcements in the last few years, and we've finally seen the share price rally from 10.5 to 14.5 as it is today. But most of the brokers now suggesting it's overvalued by about $2.50. What should people be looking for? I always talk about earnings per share growth, because we want to not only see the earnings per share being fairly reasonable for the level of asset value that these people have, so a good return on capital and a good dividend, but if they're just paying out everything that they're earning and they're not really earning much, it's not actually a good company, is it? No. What you're looking for is, firstly, a strong position in an industry. Secondly, the industry is growing. Thirdly, the return on equity and the return on
incremental return on equity is growing as well. And if you can get all those dynamics right, a stock can perform quite brilliantly over 10 years. If you get it wrong, the stock can go sideways. So we've talked about, for example, just take Commonwealth Bank of Australia and see what that's done over 10 years, and then conversely take the National Australia Bank and see what that's done over 10 years. One did quite superbly domestically, and one beat their chest 10 or 15 years ago, went over to the US, went over to the United Kingdom, went over to Ireland, and more or less stuffed it up. And so its share price has really, in capital terms, not moved much in 10 years, where the other one has tripled. So you've got to get the dynamics of the underlying company right and make sure that their earnings and the return on equity is going from bottom left to top right. You only need 10 or 15 stocks in a portfolio, but if you can do that, you'll do very well over the medium to longer period of time.
Yep. There's a bit of work to be done to identify those sorts of companies, isn't there?
There's a lot of analysis, and obviously our retired friends who love it and have the time to do it and enjoy it and have the inclination to really dig deep, do it. But that's one of the reasons that some outsource it to fund managers like Montgomery.
Absolutely, no doubt in the world.
No, it's not.
David, what are your thoughts on this one?
Well, twofold. I think longevity means that people will work 5 to 10 years longer, point one. And point two is I think the record low interest rates have scared a lot of people. So if you go to the United Kingdom, Western Europe, Japan, United States, interest rates are effectively nil or close to. So the bottom line is it doesn't matter if you've retired on $1 million. You might literally earn $5,000 a year on that, or $10,000 a year on that $1 million. Right, risk-free, just cash in the bank. In Australia, it's $25,000 at 2.5%. You're living below the poverty line. So you've worked an entire life, you've got $1 million and you're earning 2.5% in the bank as an example, and you're thinking, I'm living below the poverty line. So what happens is you just delay your retirement, particularly if you're relatively fit, and particularly if you think you've got a good chance to living to your 85 or 90. You just say, look, instead of retiring at 60, let's review it at 65 or 67 or 68. I'll still have 18 years of retirement. I just won't have 28 years of retirement. Yeah.
Well, it's a sad situation when you think about it, because 6-7 years ago, when interest rates were at 7 or 8% for a term deposit, a person with $1 million was living off $80,000 a year tax-free. It was a great lifestyle, well over the average couple who need around about $58,500 a year, according to the ASFA survey, the Australian the Association of Superannuation Funds of Australia, are suggesting that that's what you need these days. And we had an email from, a call from Margaret last week, who was talking about term deposits at 2.2%, and hers were coming off somewhere around about 5% interest rate, and even 5%. Remember, at the time, people were complaining about 5%. Now we're staring down the barrel.
Well, this is what quantitative easing's done. It really is hurting that generation who have saved all their life and been very, very good savers and been good sort of corporate citizens. They're really getting slaughtered, and it's not good. And as I say, at least they're getting 2.5%. If they were in Western Europe, UK, Japan or North America, they'd be getting 0.5%.
It's even worse, isn't it?
It's terrible.
A lot of people are returning to equities now at a time where equities have already had a pretty good run.
Correct. So 3 years ago, the equity market wasn't a million miles away from 4,000 points. Early this calendar year, it got up towards 6,000 points. We thought it was too hot, and we got quite cashed up. It's come back to roughly 5,500 points. The big issue for us is that the rally over the last bunch of years has not been earnings driven. Earnings over the last 5 years in totality have really done nothing. So the resource sectors generally, its earnings have gone south. The industrial sector's gone north, but in net terms, earnings in the Australian market have done nothing. It's all been a re-rating because of low interest rates. Now, to me, that is not sustainable. It's a bit like the house next door was worth 600 grand 3 or 4 years ago. Today it's worth $1 million, and you go, sorry, we can't rent it out for $1 more than we did 3 or 4 years ago. Why has it suddenly gone up by 50 percentage points or whatever it might be? You just know that those things don't last.
Money's cheap.
Yeah.
They just don't last.
Hello. Could I ask your people there what your thoughts of how the international versus Australian shares will go in the next, say, 4 or 5 years?
Yeah, good on you, Paul. This is a really good question. I was going to ask you before you left whether it's invested directly in shares or whether you're using managed funds or ETFs.
managed funds.
Managed funds. So you'd have Platinum, Magellan, those sorts of companies probably. David, you're going to have a field day on this one. Go ahead.
So, Paul, Australia did wonderfully well relative to the world for three reasons. Firstly, the superannuation guarantee levy, franking credits, meant that Australia really did have home ground bias. And then thirdly, and the most important factor, was the pull-up effect of China. So we saw iron ore price, for example, go from $20 a tonne to $180 a tonne. We saw coal go through the roof. We saw copper go through the roof. But the pull-up effect from China is now well and truly over. And for example, the mining sector as a percentage of GDP was 2 or 3 percentage points for decades and suddenly jumped to 8 percentage points. The problem was that when times were so good a few years back and the Australian dollar was well above parity, as a government and as a people, we forgot to drought-proof the farm. And now what's happening is that the party's over, the hangover's set in, iron ore's gone down by 2/3, coal's halved, oil's halved, gas is halved, and the hangover's well and truly set in. And I think Australia is now, in terms of that pull-up effect from China, it's over. So I think in general terms, the big tailwind that we've had for 15 or 20 years is now becoming a little bit of a headwind. So my personal view is that that the world markets in general terms, all things being equal, will do a little better than Australia. And already in the last 2 or 3 years, we've seen the Australian dollar go from 105 cents to 73 cents. So you've already had an enormous gain just in the depreciation of the Australian dollar, assuming you've been unhedged. I also believe the Australian dollar has got further to decline. But most importantly, I just think that there's a lot of very good global stocks that aren't particularly expensive, whose earnings are marching from bottom left to top right. And in Australia, I think it's harder and harder and harder to find those opportunities.
Any thoughts on ETFs, exchange-traded funds, versus, say, well, let's say ETFs, direct shares, or managed funds? Yeah,
so ETFs are fine if you want to get an index return. And that simply means if the index goes up 10%, you'll go up 10. If the index goes down 10, you go down 10. Value investors would always argue that after expenses, you could do neatly better than a particular benchmark. But within ETFs, there are pockets. So there might be, for example, technology pockets, or there might be healthcare pockets. So again, try and find those pockets that are moving from bottom left to top right, as distinct from coal stocks, as a simple example, or iron ore stocks, as a simple example. So find those pockets where the growth is solid, sustainable, and should be around for many, many years, and enjoys a really, really positive long-term dynamic, such as demographic or age or whatever it might be, or smartphones, or whatever it might be.
Yeah. And John, g'day John, welcome to the show. Go ahead, what's your question?
Oh, yeah, look, thanks for taking my call. Look, I'm a self-funded retiree, and I've got a number of shares in Transurban, symbol TCL, and I'm thinking about selling those and buying some shares in Magellan, MFG. Just wondering what your thoughts are.
Ooh, so you're leaving your late run for Magellan, but let's go to David on this one. David, what do you reckon?
Well, firstly, John, Magellan is a fund manager. It's highly operationally leveraged to how much pie it actually controls. At the moment, the pie is about $35 billion. It's been one of the most successful stories in the Australian market in the last sort of 7 or 8 years. The question is, if it goes from $35 billion to, for example, $50 billion or $55 billion, its revenue line goes up by 50%, but it really hardly needs any additional people to run that extra $15 or $20 billion. So what happens is the earnings then drop to the bottom line very, very, very quickly, and the share price should perform accordingly. Magellan Financial Group, in fact, owns a smaller part of the business that I run called Montgomery Investment Management. We do own some Magellan shares, and my valuation on Magellan is about $22 a share. So we think there's a little bit of upside there from the current $18.5. It's been very volatile recently as world markets have moved around, and secondly as the currencies moved around. But we would argue that all things being equal, it's got a few dollars upside. on Transurban, what I would argue there is that these infrastructure plays are very, very focused on interest rate levels. And what I would say that if interest rates go up, these infrastructure type plays will eventually get hurt. And the reason is they've got quite a large amount of indebtedness, and they do have a very, very reliable income stream from, typically in this case, roads. And the roads typically, the price of the roads typically go up at inflation or 3.5%, whichever is higher, not whichever is lower, whichever is higher. So if you compound that over 10 or 20 years, that's very lucrative. But I would also argue, because of the indebtedness, if interest rates go up, those sorts of stocks will eventually get hurt.
No doubt, and they did get hammered during the GFC, didn't they? A lot of lack of liquidity, high debt, that sort of stuff was right on the nose, wasn't it?
And even when interest rates went up over that sort of April-May period, Sam, a lot of those, I'll call them long duration stocks, fell much more aggressively than the overall market because simply they've got a lot of debt.
TCL got slaughtered around the 24th of the 6th, I think it was, just towards the end of the financial year where we had that big dip, and a lot of those stocks were certainly out of favour. But, you know, you're talking about Telstra acting as a bit of a bond. TCL is a similar fashion, but it's like a bond with a crap load of debt.
Correct. Correct. And so so they've obviously enjoyed a massive rally in interest rates, but one day interest rates will reverse.
Yeah, absolutely.